One of the most common questions I get from business owners when they join us is, should I elect S-Corp or not? At the end of the day, S-Corps are kind of the end all be all in most people's mind. What you'll see on social media is, oh my gosh, you're making $50,000 of profit. You need to become an S-Corp. And this is just simply not true. I think, really to start this conversation, we need to break down the different tax structures. So understand when most people say be an S-Corp, most times you're an LLC and then you're taxed as an S-Corp. That's just how it is. Most people set up their business as an LLC. They're either a sole prop, which just kind of is a disregarded entity. Then you have an S-Corp. And then you have partnerships. And those are really the three most common types that you're going to see. So most times when people are considering S-Corp, they're either a sole prop and then considering becoming an S-Corp, or they're a partnership and then considering becoming an S-Corp. Really how an S-Corp works is that you actually start to pay a salary now. So if you're a partnership or you're a sole prop, you do not pay a salary to yourself. If you have employees, yes, you would still set up salaries and pay them through wages if they are meant to be a W-2 employee versus a contractor. If you think about just a regular LLC, you make $200,000, let's say, then you have $30,000 of expenses, you have $170,000 of profit. So all of that flows through to your own tax return. All that really means is you're taxed on that $170,000. You have standard deduction, then you have some at 0 from the standard deduction, then you have some at 10, some at 12, some at 22, and so on. And then you'll have this effective tax rate. But then you also have self-employment taxes. With a partnership or a sole prop, you are taxed on all of that at self-employment tax levels. Really, that's 15.3%. So if you made $170,000, you'd owe $170,000 times by 15.3% of self-employment taxes. This actually pushes you into having a pretty high effective tax rate if you think about it. You have these marginal taxes, right? You get that effective tax rate, and then you have an extra 15.3% on that entire income. And so if you look at somebody who's W-2, they're going to look like their tax rate's a lot lower, but it's because they're only responsible for half of those self-employment taxes or FICA taxes, however you want to look at it. And this is where people bring up S-Corps. So they're like, oh, great, you have $170,000 of profit. Why don't you just become an S-Corp? And the reason they say that is because with the S-Corp, you have the salary side and then you have the profit side. And so with the salary, you pay all the taxes and self-employment taxes on it. So let's say you have that $170,000 of profit. You decide, hey, I'm going to move to $100,000 salary. Okay, with that $100,000 salary, you're going to have both sides of the self-employment taxes because you're the business owner. So the business pays half. You as the employee being paid W-2 pays half. That's still $15,300 on the $100K, but the other $70,000, you avoid those self-employment taxes. You don't pay those taxes on the profit. That's really the big difference between the S-Corp and the sole prop. But what happens is most times people see that and they say, oh my gosh, I might as well become an S-Corp, right? Now I'm an S-Corp. I save $15,300 or 15.3% tax on that next $70,000. But that doesn't really tell the whole story. So there's a few things that change. For the first one, with the sole prop of $170,000, you get the qualified business income deduction, which is a 20% deduction on profit. So you'd have $170K times by 20%. All of that is a deduction to you. Now, if you're an S-Corp, that changes, right? We just said you have the $100,000 salary. So now the qualified business income deduction is only $70,000 times by 20%. So you lose a lot in the deduction. That's part one. Part two is what you can put into retirement accounts is different. So in the sole prop, let's say you have a solo 401k, you can put in $23,500 on the employee side, and then 20% of the profits less half of self-employment taxes. If you move to this S-Corp and you get $100,000 salary, now you can only do the $23,500 plus 25% of the $100K. You end up being able to put less into the solo. And then lastly, the other part that is different here, you just have added expenses. So if you're an S-Corp and now you have payroll, now you have added bookkeeping requirements. Now you have another tax return. The fees start to add up. And I'm not here trying to tell you that S-Corps are bad. A lot of our clients are S-Corps, but you just have to factor in all the numbers. What we find is most people just look at self-employment taxes and they say, oh, switch, you should now become an S-Corp, when they don't think about retirement contributions, they don't think about the qualified business income deduction, etc. What I find is for most people, if your profit is 100K or lower, S-Corp definitely doesn't make sense. If your profit is 100 to 200K, it depends on your job, because the wages side of this S-Corp isn't standard. People all the time will say, oh, what do I need to have my reasonable salary if I have 200,000 profit? There isn't a simple answer. If you are an artist, versus a marketer versus a doctor, those reasonable wages are going to be different. You basically have to pay yourself what you would be paid if you were W-2. The best way to look at this is, what would it cost to replace yourself in that situation? You know, if you have 200,000 of profit and you're a doctor and your salary has to be 170, well, the S-Corp is going to end up hurting you more than it's going to end up helping you. I will say there is a caveat to this. Big downside of it is you can't elect into PTET. PTET is basically the pass-through entity tax credit. What happened was in 2017, with basically Trump's tax bill, they reduced the SALT cap. The SALT cap is basically how much of state and local taxes can you deduct. Well, you can only deduct $10,000 today. So what ends up happening is PTET was created, which basically means you can pay a decent amount of the state taxes you'd owe through your business, which allows it to basically be deducted federally. And so sole props don't get the ability to do this, but partnerships and S-Corps do. And so sometimes it does make sense to move from a sole prop to a partnership or to an S-Corp simply to be able to pay those state taxes through the business, because that leads to a ton of great tax savings. Really, to recap, S-Corp is about self-employment tax savings, but you have to understand you have to have a reasonable salary. That part is subject to all the self-employment taxes. The business pays half, you pay half is deductible. But understanding that that reduces profit, which might reduce the qualified business income deduction. It will probably reduce what you can put into retirement accounts, but S-Corp can also open up the ability to do PTET. The other thing I want to hit on, though, is a little bit deeper on the qualified business income deduction, because the qualified business income deduction is not as simple as it's 20% of profits is deducted. That is how it works until you kind of hit this phase out. Once you reach about $383,900 of income, from there to $483,900 of income, you basically have this phase out. And then when you get above $483,900, let's start with you don't get the deduction. If you're what's called an SSTB, which is basically a service business, this could be a consultant, it could be doctor, it could be dentist, it could be lawyer, it could be CPA, it could be financial advisor, etc. You don't get this deduction anymore. But if you're not listed as an SSTB, then the deduction now becomes the lesser of 50% of W-2 wages or 20% of business profits. So if you're a partnership or you're a sole prop and you don't have any wages, but you're QBID eligible, when you get above that $484,000 number, you would get a $0 deduction. But if you move to S-Corp, you add wages, that's when you can start to get this deduction. So let's say you were going to make $1 million as a sole prop and you're QBID eligible, no wages, you get a $0 deduction. If you move to S-Corp and let's say you have $250,000 salary, $750,000 profit, 20% of 750 versus 50% of that 250, you have to take whatever is lower. But that is a huge difference, right? Now you're looking at potentially $100,000 tax savings tool, just depending on what your tax rate is. We have clients who come in and we need to move them to S-Corp pretty quickly, and they'll save six figures simply between self-employment tax savings, PTET, and actually maxing out QBID, some even above 200K. So this is a really, really powerful tool. At the end of the day, I know I went through this super quick. S-Corps are a really good tool when used correctly, but it really is about using it correctly. At low income levels, low profit levels, S-Corps are kind of more hassle than makes sense. When you get to this mid-level, a lot of times it's a good tool. And when you're at the high level, it can be a really good tool for self-employment tax savings, for PTET, for maximizing QBID, etc. But at the end of the day, you have to run all the numbers. Work with a tax team, work with a financial team like us. We'll help you analyze what makes sense for you, and then you can go from there. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.